Hello and welcome to this session. Today we will discuss adjusting entries, which is part of my basic accounting bootcamp designed to teach you accounting from A to Z. In the previous session, we covered a series of transactions using debits and credits, journalizing, posting to the ledger, and most importantly, preparing a trial balance. In this session, we will build directly on that foundation. We will take the trial balance that we prepared from the prior session and prepare the appropriate adjusting entries as part of this accounting cycle. If you are unsure where the figures on the trial balance are coming from, I strongly recommend reviewing the prior recording. This is a comprehensive series of lessons that guide you through the entire accounting cycles step by step. So in this step specifically, we will be focusing on the 4 types of adjusting entries. Often this topic is challenging for accounting students. The 4 are prepaid expenses, unearned or deferred revenue, accrued expenses, accrued revenues. Now, sometimes they go by other names, but those are basically the 4. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website. We're going to be working with the adjusting entries as of October 31st, 2024. As I mentioned earlier, we have 4 types of adjusting entries. I'm going to break them down into 2 main groups. We have the deferrals and we have the accruals. Under the deferrals, we have prepaid expenses. Sometimes we can call it in your textbook or in your review course might be called, rather than prepaid, it might be called deferred. Same thing. We have unearned revenue, same exact thing. In your book, it might be called deferred. Same exact thing. Under accrual, we have accrued revenues and accrued expenses. In total, we have 4. And if you know anything about me, once we have a list of items, I'm going to go over each item separately, starting with prepaid expenses. And I'm going to be working with this trial balance to adjust the prepaid accounts. Remember, we are working as of October 31st, 2024, starting with prepaid expenses, 1 of 4 adjusting entries. First thing is, what are prepaid expenses? Well, prepaid expenses are any time you pay cash in advance of the expense. So before the expense was incurred, you prepaid for the expense, and that prepaid will benefit future period. What could be some examples of prepaid? Well, you can prepay your insurance, you can prepay your rent, supplies is a form of prepaid, any prepaid account is a prepaid, building and equipment is a form of a prepaid. Why? Because you will buy those building and equipment and you will use them in the future while the expense takes place in the future. You can prepay for your advertising. Simply put, any expense can be prepaid. Now, for our purposes, first you need to know which account need adjustments in form of prepaid. I would say for our purposes, we purchase some supplies, we purchase prepaid rent, and we have equipment. So simply put, in the real world, or this is how it works, we need to ask ourselves, it seems we have 3,000 of supplies. Ask the employees, do we still have 3,000 worth of supplies? And if they say yes, we still have 3,000 worth of supplies, no adjustment is needed. If we have 3,000 of supplies, our trial balance showing 3,000, then we have 3,000. There's a good chance we don't have 3,000 of supplies, because this amount is when we at the beginning of the period or when we purchase the supplies. At the end of the period, we might have lost some supplies. not lost, use them, or lost for that matter. So if that supplies is consumed, then we have to reduce our supplies. Therefore, a typical prepaid will take the following journal entry. When we adjust prepaid, assuming it was recorded as a prepaid initially, again, assuming it was recorded as a prepaid initially, which is the normal way in quote, we reduce the prepaid and we increase the related expense. And the best way to do it is to work an example. Right now we have a prepaid called supplies and we have $3,000 in that prepaid. Let's see what happened after our employee counted the supplies. After the employee counted the supplies, at month-end count, they show we still have $500. So right now we have $3,000. That number is incorrect. That number should be $500. This is the correct balance. What does that mean? It means I have to make an adjusting entry. I have to reduce my supplies by $2,500. I would reduce my supplies. As a result, I have to expense my supplies. I will debit supplies expense. So the entry will take increase my expense, reduce my asset supplies. Notice by $2,500. As a result, I have the proper balance of $500. What happened if I did not book this entry? If I did not book this entry, my assets will be overstated. I will have more assets. I will show $3,000, but in fact, I only have $500. My expenses will always be understated by $2,500. As a result, my profit will be overstated by $2,500 because I reported less expenses. So notice how this adjusting entry affect the balance sheet and affect the income statement as well. So we're done with this supplies. Basically, the supplies, it's going to go to $2,500. Now, we said prepaid rent is another form of prepaid, and we need to ask ourselves, do we still have this much of prepaid? And the answer is most likely not. Okay, most likely not. We have $12,000 of prepaid rent. We purchased this prepaid rent on October 15th. Guess what? And we purchased it for 1 year. Therefore, if we take 12,000 divided by 12, our prepaid are consumed at $1,000 per month. However, since we bought it on October 15th, we're going to have to reduce it. We have to split this 1,000 in half because since October the 15th, we consumed $500. What does that mean? It means we have to credit our prepaid $500. Now the prepaid balance is $11,500 and we have to debit our rent expense $500. So simply put, our expenses are increased, our prepaid are reduced. Now the new prepaid balance minus 500 is 11,500, and this is the supplies was minus 2,500 and the remaining is 500. Okay, so this is how we adjusted our prepaid rent. So we're done with supplies, done with prepaid, and we'll do the same thing whether we have more prepaid or not. Equipment, as I told you, property, plant, and equipment are a form of prepaid. But remember, property, plant, and equipment, how do we consume them? Well, we really don't consume them, we use them up. They benefit our business. Property, plant, and equipment, they get depreciated. So what's going to happen, part of this 9,000, it's going to be turned into a depreciation expense. For the purpose of this session, since I'm teaching you how to prepare adjustments, I'm going to be giving you the depreciation amount. But you're going to have to learn eventually how we come up with this number. So I'm going to say estimated depreciation happens to be $250. What does that mean? It means now you have to record an expense called depreciation expense for $250. Therefore, you debit depreciation expense $250. What do you credit? Well, for property, plant, and equipment, you don't credit the account itself. We're going to create a sub-account called accumulated depreciation equipment. This account is a contra asset. It exists to serve the equipment account. Therefore, you're going to still have the equipment reported at 9,000. On the balance sheet, you're going to deduct accumulated depreciation. It's going to reduce it by $250, and that's going to give us $87.50. And this is called the book value of the equipment. Same concept. If you did not book this entry, your expenses will be understated. You will have less expenses.
As a result, your profit will be higher, and your asset will be shown at 9,000, while your asset should be shown at book value 8750. Your assets are overstated. So it's very important to understand how prepaid expenses work. It doesn't matter now which prepaid expense are you dealing with. When you adjust the prepaid, assuming it was recorded initially as a prepaid, you reduce the prepaid and you increase the expense. Now, why am I saying initially recorded as a prepaid? Because some prepaid, what some companies do, they first initially they record everything in expenses, then they make an adjustment, take it out of expenses, whatever not used, and put it into prepaid. Well, that's a story for a different lecture. Okay, but this is what we have here. We have to, in this session, since we're learning the basics, you have to know the basics. And eventually, when you are faced with that exception, which is the alternative method, you'll be able to do it. Now let me show you from a trial balance perspective what happened to each account. These are the unadjusted balances. This is the adjusted column, and these are the adjusted balances. Again, we dealt with three accounts: supplies, prepaid, and equipment. Supplies was 3,000. We credited supplies. The adjusted balance 500. Prepaid equipment was 12,000. We reduced it by 500. The adjusted balance is 11,500. Equipment, we did not have accumulated depreciation. We credited accumulated depreciation. Now the balance is 250. And for every credit, we have a debit. We debited supplies expense. We debited rent expense. We debited depreciation expense. And those are their balances because they did not have any existing prior balance. The next adjustment is unearned revenue. This is adjustment 2 of 4. What is unearned revenue? Unearned revenue is when you are receiving the cash in advance of performing the service. So you receive the cash in advance of the revenue. That's how it works. Somebody pay you, but you did not do the work yet. You're going to have to do the work in the future. In the real world, when you subscribe for a magazine, when you buy your airline ticket, when you pay for your hotel, these are all unearned revenue for the seller. And what happened is, until they perform the service, they cannot book it as revenue. So let's take a look at our trial balance and see if we have an unearned revenue. It looks here that we have 4,000 of unearned revenue. Somebody paid us 4,000 in advance. How do we adjust unearned revenue? Unearned revenue, it's always going to go down once we adjust it because we already have the unearned revenue. So we have 4,000 in unearned revenue. Unearned revenue will go down, and as a result, revenue will go up. So as a result, we're going to earn this revenue. Okay, so what Adam did, this is Adam Company, earned 1/4 of the 4,000. 1/4 means earned 1,000. 1/4 of 2,000 is 1,000. So what does that mean? It means I'm going to debit unearned revenue 1,000. I'm going to credit my revenue 1,000. So this is the journal entry. Now, how much unearned revenue do I have left? The balance is 3,000. The 3,000 is the balance, which is as a result of reducing the unearned revenue from 4 to 3. So simply put, it's going to go from 4 minus 1,000. The unearned revenue will be 3. Notice what happened if we did not book this entry. If we did not book this entry, we will have less revenues, $1,000 less. And we will have more liabilities of 1,000. Because our liabilities went down, we would have had more liabilities. So we really want to make sure we book our unearned revenue. If we have unearned revenue, we want to record it as revenue if we want to look good, right? And that's what we want to do. From the trial balance, notice we had 4,000 of unearned revenue. We're going to debit unearned revenue 1,000. The remaining balance, the adjusted balance, is 3. And what's going to happen, I had only 10,000 of revenue. I'm going to add 1,000 to it from the unearned revenue. Now my revenue is 11,000. 11,000. The third type of adjusting entries are called accrued revenues. This is 3 of 4. First, we need to know what are accrued revenues. Well, accrued revenues are revenues performed but not recorded. So we did the work, but we did not record the work. Well, guess what? If we did the work, it's revenue, therefore we have to report it as revenue. So other example could be any work done but not yet recorded. You did the work for someone, you did not record it as revenue, it's time to record the revenue. So how do you record accrued revenue? Very simple. You're going to record the revenue, you're going to increase the revenue, but obviously you did not get paid, you're going to increase an account receivable. So every time you adjust revenues, every time you adjust accrued revenues, and accrued means record, this is the accrual. What do? You're going to debit a receivable, credit a revenue. Well, let's take a look at this. Adam Inc. performed $4,000 of work not yet billed. So we did the work, we were busy, we did not bill the client. It's the end of October. We told our accountant, look, we did the work, we did not bill the client, record 4,000 of revenue, and obviously bill them as well for that matter. So what we do is we debit account receivable and we credit consulting revenue. So simply put, we're going to add another 4,000 to account receivable, and we're going to add another 4,000 to our revenue. Otherwise, our revenues are understated and our assets, account receivable, are understated. So from a trial balance perspective, account receivable here was 4,000. We're going to add to it 4,000, and we're going to end up with 8. Okay, we're going to end up with 8,000 of account receivable. Revenues was 10,000. We added 1,000, then we added 4. Now revenue is 15,000, the adjusted balance. The fourth type of adjusting entries are called accrued expenses. Accrued expenses sounds like accrued revenues, but rather than revenues, they are expenses. What are they? Expenses incurred, but not yet recorded. Just like we have revenues that we did not record, we might have expenses that we did not record. Examples could be salaries, interest expense, any expense that you know you have to account for, but you have not yet. It's the end of the period. If it's related to that period, you book that accrued expense. So simply put, you're going to increase an expense when you book accrued expense, but since you're not paying it now, you're going to increase a liability. So if you debit rent expense, you credit rent payable. If you debit salaries expense, you credit salaries payable. If you debit XYZ expense, you credit XYZ payable. Okay, so this is basically, you have to find out what expenses that you accrued. So for example, the assistant earned $1,000 worth of salaries, but not yet paid at the end of October. So the assistant that worked with Adam at his consulting company earned $1,000, but Adam did not pay this individual by the end of the month. Well, if not, we have to debit salaries expense 1,000, credit salaries payable 1,000. Why? Because we have to accrue this expense. We have to accrue. Otherwise, our expenses are understated and our liabilities are understated. Simply put, we are responsible for $1,000 for that assistant. I hope this makes sense. Another example will be interest incurred as of October on the notes payable. You remember we borrowed money on the notes payable is $100. What does that mean? It means because we had a loan at the bank, by the end of the month, the loan accrued interest. Interest is an expense. We did not pay the interest yet, but we have to record the interest expense. Remember, it's a matching principle. We have to match the expense to that period. Therefore, same concept. We're going to debit interest expense, credit the related payable interest payable. So accrued expenses, you would always increase an expense and increase a payable, the related payable to that expense. Why? Because you are recording an expense not yet paid. Eventually, you will pay it. Once you pay it, you would reduce the payable and you would reduce the cash once you pay that expense. Let's take a look at this at the trial balance now. We debited interest expense $100. We credited interest payable. We did not have interest payable. Now we have 100 of interest payable. We did not have interest expense. Now we have 100 of interest expense. And also we accrued, what else did we accrue? We accrue wages. We accrued $1,000 worth of wages. We debited wages and we credited salaries and wages payable. Okay, now wages expense total is $6,000. Let's take a look at the complete adjusted trial balance. Now we move everything to the end. Now we are ready to complete the adjusted balance. 68,000. We did not adjust cash. Eventually we'll get to that. Account receivable went from 4 to 8 because we added another 4,000. Supplies went from 3,000 to 500. Prepaid went from 12,000 to 11,500. Equipment stayed the same, not really, but we reduced it by accumulated depreciation. The notes is still the same. Accounts payable the same. Unearned service revenue was 4,000. We reduced it to 3 by debiting it 1,000, so on and so forth. For example, our salaries expense were 5. We added 1,000. Now it's a 6. Service revenue were 10. We added 5. Now it's 15. The few things hopefully you notice as we are going through this. Adjusting entries would always affect an income statement account and a balance sheet account. So if you look at any of these entries, for example, if we take the 4,000. We debited account receivable, credited revenue. Account receivable is a balance sheet account. Revenue is an income statement. So you're always affecting either a balance sheet or an income statement. And always you are increasing either a revenue or an expense. So you're affecting a revenue or an expense. Usually, if it's the proper entries, they're both going up. Okay, if we're going through, we're not using the alternative method. Now this is the adjusted trial balance as of October 31st. In the next session, I'm going to say this is the adjusted trial balance that we prepared in this session, and based on this adjusted trial balance, we are ready to prepare our financial statements. At the end of this recording, I will invite you to visit farhatlectures.com, where you can look at additional examples, exercises, multiple choice questions that will help you reinforce your knowledge, whether you are a student or studying for a professional certification. We are here to help. Your job is to invest in yourself. Good luck and stay safe.